Today's topic, why the S&P 500 index is not enough and when is it time to bring in a pro. Today's topic is coming to us from another fantastic question. I just recently had 2 speaking engagements at 2 different conferences, so some of my favorite content ideas comes to me in those hallways when we get these one-off questions, and it makes me think, well, if you're asking me that question, that's probably a very common question. And this question went something like this. Why would I ever need to hire a financial planner if I can just invest in a few index funds and get really good returns? And I thought to myself, there's a lot about that comment I like, but there's also a lot about that comment question that we need to add context to and maybe even kind of bring back a little bit of the overconfidence that has built up based on how the market's really responded over the last 10 years. Stay tuned. We're going to get into that next. Okay, first favorite ask. If you have not subscribed, please subscribe to the channel. Bell icon gets you a notification every time we release a new video weekly. Click on the thumbs up, help share the message. That's it, only pitch. Let's get into it. So let me share my screen. I'm going to share my screen here first. That's like my favorite thing with this month's video. All right, I'm going to share this chart from MFS. No reason why I chose MFS. Honestly, it was just my first Google search where I could pull up this chart because I love this chart. This is one of my favorite charts to show performance through asset classes. So what you're looking at is performance going back to 2005, 20 years of data, and which asset classes perform best. This is my favorite chart on just saying this is why diversification is important. But I will say there's more and more individuals that are coming to us as new clients, and even more content that other advisors or other influencers are also kind of seeing this trend where diversification seems to be getting smaller and smaller and smaller. And I want to point out why this is a little bit concerning, but I can also see where it's coming from. So just look at this chart here. Let's just go back to 2015. Large cap growth, for the most part, this is your S&P 500, at least the most heavy weighting towards that. You know, there's some large cap value in here too. But look at this. 6 of the last 10 years. 1, 2, 3, 4, 5, 6. It's the winner. Not even in the top 3. The outright winner. I mean, heck, if we include the second place position here, 7 of the last 10 years, large cap growth, aka leaning towards the S&P 500, has been the top performer, which is also, this is a very common question. A lot of people have started to give up faith in international. Look, we're international. Again, last 10 years, international, now 2017, not bad. 2023, not bad. But for the most part, in the second half of performance for a lot of these accounts, even over the last 20 years, average 4.81 compared to large cap growth, about, we'll round up, call it 13. 8% swing there. That's a big difference, right? It's a big difference, especially let that compound over 10 years, few decades. But if you go back to the previous 10 years before that, international was hanging in there, pretty much a top 4 performance in most of those years. Now, this is not just a conversation on US stocks versus international. This is full diversification. I mean, you can even see commodities had some good runs here. Now, if you go over to this annualized return, yields have been pretty low throughout this period of time, right? And you're starting to see that show up here. Cash, low, which we expect, low yields, but then also bonds. So you're getting these 3 underperformers in here, and commodities. Commodities had a really bad stretch from 11 to 15, right? Really not looking too hot there. And then that's having an overall effect of 0.3. The whole point of me sharing that chart was to show you that it feels like a lot of people have started taking the investment management part for granted. And while I am the biggest believer in modern portfolio theory, diversified, low cost, utilizing index funds, the biggest thing here, control your emotions and you're going to be fine. But I'm getting more and more concerned about how many people I see on lacking in terms of diversification. And I think there's some larger stories here, right? Our recency bias, right? In the last 10 years, US large cap S&P 500 has outperformed dramatically. And then you're getting no yield from the bonds and the cash. And then on top of that, international, is MIA for the last 10 years, somewhat. And you can even see here, the diversified portfolio, which is kind of my favorite chart in here, is kind of hanging out right in the middle, but still about half of that. And this is a conversation we have every review meeting season, at least for the past few years now, right? Hey, the S&P 500 has done 33%. How come I'm only at 10? And we come back and we say, well, you're diversified. You did have that exposure to the large caps, the S&P 500, but we also had international here at 3.82. And that's having an effect where I think more. Now, the whole point of this video is to get into why professional management can also be a large value add. But I wanted to lead with this because whether you're watching this video in terms of diversification or when is it time to maybe look for a new money manager or look for your first money manager, I wanted to start with that chart in there. And again, the diversified portfolio, I'll put the link here. I'm actually putting this in my notes here. We'll put the MFS link to that chart too, so you can see that. Now let's get into the main form of the content. So the main goals here are, when do I need to hire a pro? When do I need to maybe look to hire an investment manager? Here are the main things that I listed. First one we always start with, time. We work with physicians. I will always tell our physicians, you are so much smarter than I am. You had college, medical school, residency, fellowship. You are the definition of extremely smart. Personal finance should be a walk in the park. But here's the thing that we notice the most with our clients when they hire us. They don't want to do it because they want to save that time for either more things they love on the work side, or more importantly, at least from our side of it, they want to spend more time with their family or doing, things in the hobby side or travel, things that they really enjoy, that work-life balance. So that is the main thing that we always bring up. When may it be time to hire an investment manager? Well, maybe if you just want some of your time back. And early on, in those accumulator years, the investment part should be a little bit more straightforward. For example, when we are talking to prospective clients, we'll usually note that the investment part of what we do, maybe 15, 20% of our time, because we do believe in modern portfolio theory. We're going to spend a lot more time on the cash flow, the budgeting, the real life decisions on how much home, the kids to private school, what college can the kids go to, tax planning, estate planning, insurance planning. That's where we spend the bulk of our time. We'll always note, we actually think our biggest value add year in and year out, but specifically over long periods of time, is actually the tax planning side. So first one I put on my list here is just time. It may be time to look for a professional money manager when you just want time back. And when I say professional money manager, I'm really referring to a financial advisor here. Are there individuals, CFAs, that maybe only do investment management and won't touch financial planning? Possibly. I would be pushing you, gently nudging you towards more of a comprehensive model, because all of that needs to come into play. Investments need to be linked with the actual tax plan inside of your financial plan. Student loans need to be linked to the tax planning. The investments can even be linked to the student loans, right? It all kind of comes full circle. That's why we think that comprehensive view with financial planning is the way to go with it. Second, I wrote on my list, you just don't want to do it, right? Maybe you don't want to rebalance. Maybe you don't want to research funds. Maybe you don't want to have to put cash into it, rebalance everything, pull cash out, rebalance everything. You don't want to have to think about, is that percent right? Is that percent right? You don't want to read through that prospectus that was about this thick that was mailed to you. Hopefully you're not getting that mailed to you and you're saving a few trees because those things are thick and they send them out yearly, but you're getting your PDF notification and you're reading through that. Probably don't want to do that. And just the overall yes, no. I think a lot of our clients that come to us, and we work with a lot of do-it-yourselfers, right? We'll have clients that come to us, they've been doing it on their own. They just don't want to have to make the yes, no decision, or they don't want their spouse to be really upset if this doesn't all work out 15, 20, 30 years from now in terms of the financial planning, the investment management that the family CFO was taking charge of. So that's the other one to keep in mind. You just don't want to do it anymore. Third one, I'm going to give a little bit of a shout out to those of us that do this for a living, right? You're a physician. I don't trust WebMD. I go see my doctor. I don't trust WebMD to cut my knee open and see why I have some right knee pain. I go see my orthopedic to see maybe something's out of alignment. Maybe I got a little bit of runner's knee going. Maybe something's wrong in my hip that's affecting my knee. Maybe it's not my knee. Maybe it's something in my sciatica. Who knows? But I have a professional to go to. Same thing when it comes to plumbing. I don't crack over the plumbing of the house. I don't get into the electrical wires. You look for your professionals. So few things I wrote down in terms of shout outs to CFPs, CFAs, financial advisors helping their clients do this. First thing I always note is overall lifetime taxes. Building a tax efficient brokerage account. Doing backdoor Roth IRAs, right? They don't save you a penny in taxes today, but you're going to be very happy that you were doing that year in and year out many decades from now. Doing all the annoying stuff. Have you ever tried to just move money from an old 401k to a new 401k, or maybe if you're retired from an old 401k into an IRA? I always call it adult babysitting. It's not hard to do, but it is time consuming. And there's always, well, that signature wasn't the right shade of blue. Can you get us a little bit more green? Can you contact them again? Or the check never arrived. It becomes a little bit of adult babysitting. Now, the good news is you don't have to do it a lot, right? Those are usually once every now and then things, but it still is a time commitment. Balancing the risk inside of the buckets. So this is where we always refer to it as buckets, right? Your Roth IRAs are a bucket, your pre-tax assets are a bucket, your cash is a bucket, your taxable brokerage account, your joint account is buckets, but balancing the risk, not just per account, but everything. So asset location is very important in that form of conversation. Another one that still catches me off guard a little bit with new clients, but the amount of cash on the sidelines. So I wrote down utilizing all of it. The amount of times clients are coming to us and they just have a ton of cash on the sidelines. And that could have been building up over years. And even if they just would have did S&P and chill, they would have been in a much better spot. So helping you utilize all of it, and whether that's just removing the emotion from it or because you were so busy, you truly just let cash build up and you missed an opportunity. Now, if the market was down, great, buy it while it's on sale. But we just went through pretty good market runs there for a while. And we have clients coming to us with, 6 figures of cash almost on a weekly, monthly basis right now. So utilizing all of it. And the last one I wrote is just, the good stuff, helping you get everything organized, being there every step of the way. You read a blog post from White Coat Investor, you listen to a podcast from Physician Sense, and you have questions on that. Does it fit in everything? That's what we're there for, right? We're helping you review those. For our firm, we do semi-annual review meetings. We're there for you all the time through emails and that type of support. And most other advisors have that type of setup. So those are 3 scenarios where it might be time to look for an investment manager. And yes, are there robo platforms that do this? There are. And that's where we'll always come in and say, we kind of know what the fair price is, just based on like Vanguard's PAS system, around 30 basis points of what just true asset management is. Not financial planning, but just asset management, right? That's the downside to a lot of the robos. They'll help you on that one single account, but they're likely not going to integrate how that account is linked to your 401k at work and how your 401k is linked to your 1040 from this tax year and how the backdoor Roth IRA was actually not reported correctly on your 8606. And how all this comes back into why you maybe didn't get enough QBI on that 1099 income. That's the part where the robo-advisor miss. They will miss that every single time because they're not getting to that level of detail. So another reason why having your own team or your own financial advisor can be really beneficial. That's it. Those are my 3 big ones in terms of when to hire a pro. But as I started with at the very beginning of this video, also a reason why you should not give up on diversification. That will change. Those last 10 years, just like we saw in the 10 years before that, where international was performing very well. Now we've just seen large cap growth do really good for 10 years. And I'm not telling you this is going to change tomorrow. It could go another 5-10 years. It could change next week. It could never change. But having a diversified portfolio is always a smart play, especially for those longer term assets in your longer term financial plan. Questions, comments, concerns, drop those below. Again, if you have not subscribed, now is a friendly reminder to subscribe to the channel. Again, really good at nailing about 15 minutes. So this video should be right around 15 minutes as well here. Thanks again for hanging out with me. And as always, I will catch you on the next video.